Good morning. We're delighted to see so many people here at 8 o'clock. We really weren't quite sure whether we would get this many people up this early after a late night last night. And I think it's a testament to not just your fortitude, but hopefully to the great program we have put together. And we're sorry to have to start this early, but we had a wonderful day yesterday. We have another wonderful one in store, and we had to start now in order to get things done on time. So without further ado, we're going to get going. And we're going with our first panel, which is a wonderful collection for the view from institutional investors, where will returns come from? And as a moderator of this panel, we have a great friend of the Institute, Jonathan Nelson, the CEO and founder of Providence Equity Partners, LLC. Providence is a private equity firm that manages $45 billion of commercial capital. He has a very distinguished career of more than 3 decades in private equity, focusing on media, telecom, and entertainment. His numerous directorships include the Chernin Group and Univision Communications, and he's a trustee of Brown University, the Rockefeller University, and the Institute for Advanced Studies. And more importantly, he is one of the most knowledgeable practitioners in the field, and we know this is going to be a very enlightening way to start the day. Jonathan and panelists, I turn it to you.
Thank you. Good morning. We're not going to wait to let others come in because that would penalize you for being on time, which we really appreciate. It's really a pleasure to be here and an honor for all of us to share the stage with 4 managers of a lot of capital. Nearly $2 trillion is represented on the stage. Now, Hero plus a random 3 people at the conference could probably come close to that. But I hope this is both enlightening and borderline entertaining. We'll try and keep it moving along and encourage debate where we can find it. I was advised to ignore the topic of the panel, but I didn't do that completely because I thought that would throw everyone off. And the way I think about it is we have an enormous task here, all of the practitioners on the stage here, which is how to resolve the conflict between, on the one hand, a low interest rate world, and on the other, the pressure to deliver superior returns. Increasingly, alternatives has been a big part of that solution. So too has been overweighting by regions, by asset classes. If you do that smartly, that is likely to produce superior returns, and that's the mission, risk adjusted, that all money managers share. So what I want to do in digging deeper into that fundamental question is separate headlines from real issues. Divorce macroeconomics from what practitioners actually think about and what they do. So what we'll try and get at is what matters, why, and what are the panelists doing about that in the course of their work. Very brief introduction because you should all have it digitally and soft copy. Adrian Orr is the CEO of NZ Super. That's $18 billion under management. And with all these figures, they're probably outdated by a month, which means they're understated. Gordon Fife is the CEO and CIO of British Columbia Investment Management Company, $124 billion. By the way, this is not necessarily an ascending order of AUM. Nor is it in degree of difficulty of pronunciation, because I'm going to hit Jeffrey next to my right. Jeffrey Jane Subakit, who is at GIC and the responsible for public market equities and director of all equities in addition. And then Hiromichi Mizumo to my left, who's the managing director and CIO of GPIF, and they manage $1.2 trillion. And I should have mentioned GIC is about $320 billion. Or no? What is it to this morning?
It's officially greater than 100 billion.
Oh, okay. So that'll give you a sense for how much we're going to get out of Jeffrey this morning when we ask a question.
As open as I get today.
GIC would love that answer. Adrian, let's start with the question that we've been hearing a lot about since I landed. And unlike some questions you hear a lot, this one actually probably does matter. China. Your take on China, and does it really matter in your job when you think about asset allocation, where you do well, where you won't?
First, I'd like to state that I can officially say we're larger than 1 billion. So that's, I won't give you the currency. But, and Jonathan has just finished a couple of weeks of sailing in New Zealand, and you are now the lead indicator of a currency, by the way. It was at 88 cents the US dollar when you arrived. It's at 66 cents now, so it's 63. So I don't know what you did while you were there, but well done. China, absolutely critical in anyone's portfolio, as you well know. I think when you talk about China, when you talk about investing, you have to be first and foremost clear about the horizon over which you are talking. We are a very long-term fund. We have in our reference portfolio, our passive listed benchmark portfolio, probably an overweighting of a factor of 2 relative to what you would get using just straight, say, MSCI weightings. So that puts us at around 12% to emerging markets, of which, a big chunk is China and China exposure. So, and we're very comfortable with that. On top of that, we will strategically tilt in and out of all markets if we see significant value relative to current prices. We don't see that at the moment, obviously, in China per se, but we certainly see it in emerging markets as a whole. Why are we confident and comfortable with where it is? Because we have no alternative. It is a huge part of the growth engine of the world. I still strongly buy into convergence stories. Why wouldn't I? I don't have any other economic theory or rationale as to why convergence won't continue to be one of the number one explanatory reasons of growth. The challenge with China and a lot of emerging markets is that growth doesn't always equal returns to the owners of capital. And I think that is the single biggest challenge we have. I was chatting with Jeffrey just before, back from India, China. It's always a similar story. We can see the growth opportunities. How can we make sure as investors we get the returns to the capital that comes?
So if I could just get, in a word, you're comfortable with China, so the events of the last month don't concern you?
In the famous words, I think dedicated to Chairman Mao, too early to tell. But no, they don't. This is just a standard path of volatility. You make returns both through absolute growth and relative growth. Absolute growth will continue in these parts of the world over decades to come. Relative growth is going to be volatility that will create even better opportunities for investors who don't get hung up by short-termism.
Okay, that's clear. Hiro, what's your take on China? Are you as confident, or do you see risks, and does it matter?
Well, thank you very much. And I was thinking, I wish I were born in New Zealand. I could have been more optimistic person. Regarding China, it has been my biggest concern regarding our global portfolio. Before I took over this role, I used to be a private equity investor and had some intimate experience investing in the Chinese corporations. So I always been quite skeptical about the number we see on the statistics, and because it doesn't really match what I personal experience with the Chinese enterprises. So recently, after this turmoil, everybody started saying, "Oh, that's not a real number." So, but still, the economists, we use a couple of outside economists to give us a view on macroeconomy, and they are still talking about some number close to what the Chinese government shows us. So I keep asking them, is this a number you really believe, or is that a number you believe the government will produce? And most people say the latter, or some economists actually said, I think it's 4% real, but they are going to say 6, so we are putting 5 in my paper. So I think I started feeling like, the people started just trying to justify and make kind of fooling ourselves, saying like, it should be okay, it's just a normal course of the volatility. I'm not really challenging your view because I don't know who we ended up right. And also everybody has a different investment horizon. So, volatility means a lot to some people and less to the others. So I'm not challenging other people's allocation policy, but I've been quite skeptical. And also the way China handled the capital market, introducing a lot of measures to, reduce the volatility. To be honest, I was very disappointed because I used to believe in one thing, which is China, the people who I see at the senior operational level, they all, US educated or UK educated. They are all business, US business school graduates. So I thought they knew how to handle capital market. But the things that we saw recently is actually not showing that those people are decision makers. So I think, in a daily routine operation, those people will be in charge. But in this type of the emergency situations, I think they are making a lot of the decision, which is very difficult to understand from outsiders. So I saw a couple of things which makes me feel a little bit nervous. And then also, we actually try to reduce the exposure to emerging market given the Fed interest rate hike and the China issues. But interestingly, a lot of our active managers seem to have a similar view to Adrian. So my effort of reducing emerging market exposure always, undermined by the active manager actually taking into their emerging market risk. So we have the diversified manager structure, and I think that's a benefit of that, saying like, meaning our portfolio is not dictated by my perception, but it's a tough area, and I've been more skeptical than probably most of people about China.
Okay, good. We may come back to the managers undermining asset allocation in a minute, because that's very interesting. Gordon.
Jonathan.
You should be the easiest person to see here on stage. You're the tallest by far.
Right. It's more than 100 billion between us, I think.
Well, if you speak for over 100 and Jonathan speaks for a lot, between you got a lot.
So how do you, because we're sitting here in Singapore, how do you feel today about investing in emerging markets? How do you feel about risk, return? Are you weighting certain regions and certain asset classes, alternatives, or whether real or fixed income or whatever? Love to hear your thoughts on that.
Well, let me start with the fund. It's 130 billion. So I'll start with Asia because that's where we are today. And so our exposure, I guess, is not that much different than Adrian's. It's pretty close to the overall market. It's around 13% of the 130 billion is in the Asian region. A little bit more than half of that is in the developing markets versus the developed markets. But what's more interesting is the way that we've gotten the exposure historically. And I've been running this particular fund for just over a year, so some of this I've inherited. And so I'm looking at it and thinking about, do I like it, would I change it? And what I found is that of that 13% in the total fund, in our public equities, we've got about 24% of the fund is in this region. And then private equity, about 15% is in the region. But what's interesting is when I get down to some of the other alternatives, such as real estate, infrastructure, renewable resources, we're between 0 and 2%, which for me is extremely low. So in terms of how are we looking at this going forward, our public equity portfolio, the timing of some of the purchase of China has been actually quite good. But I'm more interested in the composition going forward. And I'd like to see a lot more of our private assets allocated here. And there's a reason for that, because we're talking about China and what implications. So if I can deviate back to some of the questions that you were asking before, we've been really blessed as investors for at least the last 10 years, probably the last 30 years. We've had this amazing China dividend. There's been this almost nonstop growth. If you look at what per capita GDP has done over the last 30, 35 years, going from below 300 in the late 70s to around, 8,000 or so now. It's an amazing growth. So no one can say that they didn't expect at some point that there was going to be a slowdown. So I think as investors, we're going to be exposed to some very, very slow, low global growth for quite a few years to come. And so just buying the indices, just owning the index and trying to survive off of the beta of that is not going to be anywhere near as interesting in the next 5 years, let's say, as it has been in the past 5. So what I'm saying is we're going to have to work a lot harder in the next 5 years to find returns than we did in the past. We could buy the markets in the past. We had that growth. We had the beta returns. We're going to have to work a lot harder. And that's where the private asset classes are interesting in a fund like ours. Because particularly in China, there are some great businesses, particularly focusing on consumption and on the consumer, where they've got a niche and they're starting, but they need, and this downturn in the markets has constrained their access to capital as well. So obviously they're interested in getting in access to capital that we have to offer. But more importantly, some of these private firms are looking for operating efficiencies, really just know-how, and also some foreign markets for them to sell into. So there's a lot of opportunity in some of the private markets, and I find that we're significantly underweight, so that is for us a very interesting opportunity. But I do think we're going to work a lot harder in the near and mid future for returns than we had to in the past. And it's not a bad thing, the downturn. I mean, there's been a lot of excesses have built up in the system since the Asian financial crisis. There's a lot of the easy money that flowed in from the West, and those are being flushed out of the system now. It's painful, but it's actually not a bad thing. But in terms of returns, I think we're in a low return environment for some time to come, and we're going to have to work hard to generate the returns we need.
Okay, thank you. Jeffrey, what do you like?
Okay.
And why?
Maybe
Yes.
I could answer that by addressing the China and emerging markets issue, because I think what Gordon has said is very right, which is that you cannot invest in the indices and expect that to be the source of great return. So if you look at China, it peaked in 2000 and really has never hit that peak again in terms of where the indices are. You've had deep drawdown, recovery to 2007, deep drawdown, recovery in 2014, and then possibly another deep drawdown now. So for an index investor, whether H share or A share, really it hasn't paid. And yet you've had an economy that's kept growing, businesses that have bloomed, but they're just not reflected in the benchmark indices. So I think for institutional investors especially, this creates a big problem, because we're used to asset allocation and investing in call it the broad market as the way to sort of get most of the returns. But if the indices are highly volatile and highly cyclical and go through very long, prolonged cycles, you either have to market time, meaning that you're shifting around emerging markets or in and out of emerging markets and hope to apply some skill there, or you say, I need to find the right companies and use stock picking skills or security selection skills in order to get at those returns. And I think what is true of China and the emerging markets will be increasingly true of all developed markets. So if you ask, what do you like now? I'll say, well, there's not a lot to like in the indices. The US is super expensive, right? At least by conventional measures. So you have to expect extremely strong growth in order to be very bullish about the index from the 2000 level. Bonds, there's not a lot to like, real negative returns. So I think more and more investors have to rely on skill in order to be able to generate additional returns. And that could be skill in terms of finding alternative managers who have better access, better operational capabilities, hedge funds that really are hedged but can generate skill-based returns. But we know that can't be true for all institutional investors because there just isn't that much skill available to be bought. So I think it will be a tough environment, and then as institutional investors, if we think about where we can buy the skill or where we can apply the skill, I think that's where the returns will be.
So that puts a lot of pressure on alpha.
Well, if Providence keeps going the way it has, I think that's one answer.
Oh.
I like that kind of thinking.
Ding.
It's interesting, though, your comment about China, because one wouldn't expect for a country that has grown so impressively would not be performing commensurately on return on equity.
Right. I think if you look at the indices, the ROEs look not that great, and recently actually revenue growth hasn't been that great. But there are many consumer companies that, despite the slowdown, are still growing revenues, call it 10%, 9%. So if you can buy them at the right price, actually there are companies to buy. It's just that the index itself, and obviously returning pretty decent ROEs. So I think it's a matter of finding the right businesses to buy as opposed to saying that the index itself will do well.
Good, thank you. Actually, I want to return to a comment that you made a few minutes ago about your allocations and then kind of a counterflow that your managers may be, what you're paying them to make their independent decisions. So I wanted to ask you and some of the other panelists, what's more important when you look back at your performance, or when you think looking forward? Is it asset allocation or is it manager selection?
Well, you can write a thesis on that. It's just, it's a very academic and also practical, the discussion has been made on that, the topic. But my view is, well, asset allocation is obviously most important decision for the pension managers because it's going to dictate our return quite significantly. And then we do manager selection, hoping to add alpha on the top of the the indices return, which we will be receiving by just following our policy asset allocation. So I think I just want to say a couple of things, particularly just following up what Jeffrey mentioned about the sort of limitation of indices. For example, like the China emerging market. Yeah, we want to have access to their growth engine or industry. The consumer is, the demand is driving. But if you invest into the emerging market indices, most of them have very little exposure to those industries. So we ended up buying a lot of the natural resource or financials and those, which is not exactly the industry we want to get exposure to in emerging markets. So there's a limitation on the use of index. So, yesterday, Wall Street Journal reported that we went into the partnership with the IFC to invest into emerging market private equity. I'm not confirming, but that's what the Wall Street Journal reported. So that's one possible way.
You may want an unlisted telephone number after that.
Yeah. Well, but the point I'm trying to make is, we have to be a little bit more creative because, we want to take we want to have access to the emerging market, but what exactly we want to have access to? That's the growing middle class and et cetera. Can we achieve that through investing into their indices? Or emerging market index. So far, I think I saw the limitation of using passive investment strategy. So that's why we need to have some active managers to take the advantage of the picking particular stock or particular industry. But sometimes, as I mentioned, they may actually do something different from what I thought. So, we have to live with asset allocation, which is very important, and also we try to work hard on the manager structuring to see either having access to the something beyond index or passive approach, as well as the picking something right. But of course, we have a challenge of sometimes they butt into each other. So, but I think I really want the active manager to be encouraged, because I'm a strong believer of efficient market hypothesis. So for the market to be efficient, we need to have a lot of active investors. So I really feel guilty if somebody like us ended up promoting all the passive investment and the market is dominated by passive players. I don't think that's the right way to just keep the market efficient.
Mm-hmm. Mm-hmm. Adrian.
In a low nominal return environment, you're not going to get rich by paying managers if they're not producing the returns. In our fund, we think very hard about what gives us confidence in returns. And what gives us confidence, we rank and then we allocate our capital according to that confidence. Skill and our ability to pick, assess, and have persistent skill is our lowest confidence factor that we can find. Because how do you do it? Having said that, we are probably the most active fund that certainly in the sovereign wealth fund world you'll find. And you get active by having real clarity around what gives you confidence. Diversity, will it diversify your portfolio? That's a very high confidence side for us. That's where Gordon and I have co-invested in different types of real assets that help diversify our portfolios. Market mispricing is a very high confidence, but below diversification. Then specific asset mispricing sits underneath that. And finally, there's skill. And skill, we really only think hard about it really once we've decided what we want to do and then how are you going to access it. What skill do you need to access it? Blindly paying someone to go off and be skillful is, to me, senseless. And so, I'm kind of the antithesis of strategic asset allocations. I do not believe or even understand why people would say we're going to have 10% in something called private equity. What is that? It's just leveraged equity. What I want to know is, what is the opportunity? Is it going to diversify? Is it accessing a market mispricing, an asset mispricing, or are we just got a pure skill game? We do have pure skill games in our portfolio, but we don't have a lot of capital allocated to them, and we don't have many managers who sit in that bucket. In fact, we have two managers who sit in that bucket of just pure skill. So sitting there, when you look, I totally agree, we're going to have to work. Congratulations. When times were tough, fund managers used to do lunch. We're actually probably going to have to do more than that now. We're going to have to work, but you're going to have the confidence to move. When I see huge relative value plays going on in the world at the moment, I mean, emerging markets, 30, 40% below some true hard-felt sense of fair value over a horizon that matters for us. So why wouldn't you be there? Europe, exactly the same, 20 to 30%. But that doesn't mean I'm going to allocate the same amount of capital as I would to the US if there was the same price-value gap. For a gap that size in the US, I'll allocate that much capital. That size in Japan, I'll allocate that much capital. It's got to be scaled to your confidence on relative value.
By the way, I'm curious, how do you, those numbers you cited about the disparity between your sense of value and where they're trading, how do you get to that value?
Well, there's two concepts. One's called a price and the other one's called what's it worth. The accountants and the markets will tell you what the price is today. As an investor, you have to decide what's it worth. I hope I'm not going too fast for you, Jonathan. And at times,
I got the price part. I'm interested in the worth part.
Because price is what 2 and 20 gets coded off. The price and value significantly deviate over horizons. We know that. Price was stupid 6 months ago in China. Yeah. Price was still above, even though it's collapsed. Recently, it's still above where it was 2 years ago, though. So if you had an horizon, am I running home crying yet? No. How do I feel about that correction? Better, not worse, because it's likely to be more sustainable. Would I be annoyed if I finally jumped in right at the top of that cycle? Yes. Would I been smart? No, because I would have had no sense of what is a long-term value for us as an investor, and when should I be buying more and when should I be stepping out.
Okay, that's helpful. Gordon.
I understood it, don't worry. But I've heard it 5 or 6 times before. So.
With V-men.
Although Adrian did want me to ask you a question, time permitting, on where you co-invested in your real value add.
With him?
Yes.
Okay. Well, time permitting, sure.
Okay.
But if I'm going to just add something onto that, you went through all of that, and you've all mentioned fees. But fees become a lot more important in a low return environment. So if we're going to experience a low growth, low return environment, I think a lot more attention is certainly within our shop is going to be paid. It's going to be paid to how much we're paying for what we're getting. And I said some real nice things earlier, and anybody who's in private equity is probably going to be looking for me afterwards, saying we can find private equity opportunities for you in China. But now they're going to be upset with me because I'm saying I'm going to be pretty tough on fees. Because in an environment which is so low growth, you're going to have lower returns, and fees suddenly become a lot more important in a low return environment.
I
know
can
that
attest to
wasn't your
that.
question,
but I'm used to that one. Actually, 2 and 20 is a bit of a misnomer. It's a headline for fees, but I haven't. Venture gets 2%. Private equity generally doesn't, or close, not even close. Jeffrey, how much time do you spend thinking about active managers versus allocation? And how often would you adjust your asset allocation?
Well, I think we roll allocation into some of the active managers. So JC manages a lot of the assets internally, so we don't use managers as extensively as some of the others, and so we in a sense, we sort of hope that we can build up a team that has the skill to do some of it. But part of that skill is, in fact, as Adrian described, deciding which markets are priced below value, and therefore you'd actually shift tons of capital. We don't think of it in necessarily in tactical asset allocation terms where we say we shift, but the teams within Asia, for example, that manage a Pan-Asia, would have seen prices drop in China, values emerge, and would naturally be able to shift within. Mm-hmm. So that kind of skill is really what a lot of what we do internally. We do have a fair amount, so call it a double-digit percentage that's managed outside. A lot of our private equity is managed along with GPs and or with GPs. I think we've found with external managers is that you really have to understand what in fact you're buying. So I think the Wall Street Journal had an article earlier this week about how a lot of the Chinese hedge funds were effectively beta plus. Right? You're buying a net long in the market, and so there really isn't all that much skill once you've taken away the beta. And I think that's the thing that you have to be careful about. And even when we think about private equity, somebody had mentioned a leveraged beta play. Once you take out the leverage, once you take out the fact that actually a lot of it is market timing. It's buying when the multiples are cheap and trying to exit, as they've tried over the last couple of years to exit when the multiples are high. Once you take that out, actually, that's when you can see which are the managers with the core skill that's really worth paying for. And obviously, there are managers who are able to get into deals or can provide operational leverage that otherwise wouldn't be there, and that's really worth paying for.
In the alternative space, if you think about where you are today or where you've averaged over the last 12 months, do you think that 2 years or 3 years from now, that number will be the same or higher?
Higher if we're successful, i.e. if the opportunities provide themselves, as we've all talked about. I mean, we're going to have to be thinking much harder. I mean, for our fund, I've talked about under and overweight, overweight emerging, overweight Europe, square US, that type of big macro play. But where we are thinking hard about is smart beta. I mean, it's going to be, value is going to be, and while it's been talked about a lot, it's not invested hard, but there are permanent risk premia that asset allocators like us can largely set and forget, low volatility as well. And then looking for opportunities to effectively sell insurance, I think is the best way of saying it, or a way of saying it. We have the liquidity horizon, so provide liquidity into places that people don't want to go. And that may be mezzanine debt, it may be catastrophe bonds, it's life settlements where we are. It's looking for areas where we can truly leverage our endowments rather than pretend we have some specific skill. So those are the big areas, as well as a lot of pure just completing the portfolio smart. And that's a lot about shifting the completion between derivative and physicals, but using that cash collateral and derivatives to really do a lot of the regulatory plays that are opening up, that have opened up because of all of the desires to make banks fail safe. So merger arbitrage, liquidity provision, bank capital, insurance, these types of plays are areas that we're looking at.
Good, thanks. What do you like and what don't you like right now, in terms of expressed either in overweighting, underweighting, either, and you can answer by region or asset class?
Well, what I don't like is that as a public pension fund manager, we have policy asset allocation, and obviously, although we have some deviation allowance, but it's very difficult not to take a risk, because the policy asset actually dictate us to take some level of risk to achieve the return which the government guaranteed to make our pension system sustainable. So one thing I found it very interesting and maybe challenging is that on one hand we promise to deliver absolute return, but on the other hand, 90% of my time talking about relative returns, meaning alpha. So that's a mismatch I think that most of the pension investor are facing. So at the end of the day, I always feel like shouting, give me return, I don't care whether it's alpha or beta, okay? I need money, not the theoretical analysis of what you are achieving. But that's one challenge. So we have to just work out how to deal with the absolute return requirement, and the most of the managers are hired based on what alpha they are delivering. So that's one thing. And the other thing is, we don't have as much like in-house or like a direct investment capability, and it seems unrealistic for us to build as good team as the outside managers in regardless asset classes, given our the budget and the size of people. So we have to continue to depend upon the external managers, and trying to control our exposure through restructuring manager structure takes very long. So, we also talk about whether China is doing today, but on the other hand, our shift of the asset mix will take much longer. So, all those mismatch is just, giving me, a lot of the challenges. And that's probably I want to just sort out during my turn, how to just work it out, all those different requirements. And also we have the political pressure to disclose our, performance on a quarterly basis. And it's, keep giving a lot of the pension managers a hard time. Mm-hmm. And it's a shame we don't have a CalPERS. I always want to criticize CalPERS because they disclose everything. So make everybody's in the job much tougher to work it out. So I'm actually dodging your question a little bit, but I'm not underweight in any particular. We are underweight the risk asset at the moment compared to the policy asset mix, but I think a lot of people actually feels a little bit conservative about their portfolio now.
Mm-hmm.
Same
Gordon,
question? Let me answer it first with the asset class, and then maybe something on the geography. So, but to do that, you have to understand the nature of organizations like ours, which the competitive advantages that we have when we go into the market. And the big two are, first, we have very large balance sheets, not as large as some, but nonetheless, $130 billion in my case, is fairly large still on the global scale. So we have the ability to do fairly large transactions. And the second is the nature of our liabilities are very long term. So everyone talks about having a long-term point of view, but we really do. So the nice thing there is that we've got this very long-term capital, and we never have to sell an asset at a time other than our choosing, which a lot of people found out in 2008 and 2009 that they had great assets, but that when you have to sell them at an inopportune time, the returns just aren't there. And so that leads us to look at markets which are very illiquid. That's a competitive advantage because we can go and buy something where, in theory, you're going to get a premium for taking the illiquidity risk with the knowledge that you're never going to be forced to unload this at a time other than your choosing. So that pushes us a lot more and should push us into private assets, whether it's private equity, infrastructure, real estate, renewable resources, these sorts of things. So in the first place, to answer your question about asset classes, as an organization, I feel that we are still, we have more opportunity to leverage that competitive advantage in our portfolio in the next decade than we have today, and we will continue to do that. So that would be on the asset class, and that includes in this region, but anywhere, but specifically in this region, because as I said, with China slowing down, you can't just buy the index, but there are a lot of great businesses, and a lot of those businesses are still private, and there's a huge opportunity for us to provide capital, and if we have the right partners, the know-how as well. On the geographical side, we still like this region. It'll be lower growth. It's not going to bail us out as easily as in the last 10, 20 years. But there's something that's starting at the Milken Institute, an area that I've been interested in for a while, which is Africa, and Sean's sitting over there in the corner. And I know that there's some, we've got a session on Africa here while we're here, which I'll be attending. And we did some in the previous fund that I ran, PSP, and the Federal Fund for Canada. We did make some investments in real estate in Africa. It was very early, but you start slow. And I'm talking about China slowing down, and I think it was Mike said yesterday we should be looking at where's the next growth going to come from, and maybe it's Africa, and maybe it's still a ways away, but I think that there's a huge opportunity there. Dominic Barton who runs McKinsey, I was talking to him last week, and he said, talking about Nigeria, it's 175 million people, and there were more babies born in Nigeria last year than in all of Europe. And so there's huge potential there. And I think that's the problem that a lot of us in our funds face is this issue that people who approve the investments are worried about reputation risk. Well, there's bribery there, there's corruption there. If you put money into Africa, it's necessarily going to come back and it's going to give us a bad reputation. But I can tell you, you don't have to go to Africa to find corruption. And it's, I lived a long time in Montreal, and there was, well, I guess I don't live there anymore, so I won't disparage this fine city. But there's corruption and everything. It's a question of who are you doing business with, knowing your partners, and I certainly won't allow that to stop us from finding great entrepreneurs, great businesses in Africa. So I'm very interested in this new initiative that seems to be starting up at Milken, because the hard part is to get access there. How do you organize a trip in there? How do you meet the right people going into a new region like that? And it may be a 5-year project for us to look into it, but I'm pretty excited about that. I'm not talking a lot about India because it's been covered. I think there's a lot of potential, and all I'll say about India is just show me, execute. That's what I'd like to see in India. It looks very promising, but a lot of that is already priced in. But if you can show me that it's actually going to take place, then I'd be interested to put certainly more money. We have money there, but I'd put a lot more in as well.
Great. That's a great answer. Actually, I don't see a clock here, but we're, must be close.
5 minutes.
And we can keep going, but if this might be a moment, if there is a question or two out there, we can respond.
Oh, they started the clock when you mentioned it, you see.
Oh, now it is.
Now you have a clock.
Okay.
We can go on.
Yes. Is there a mic?
One quick question is, to what extent the mark-to-market is important? Because
or just maybe the credit, or just even equity is very cheap. Another case, of course, for the long-term investor standpoint, it's a great opportunity to buy. But on the other hand, if you buy, depending on when you buy, you're going to be easily lose on a maximum market basis, maybe 10%, 20%. To what extent it is those kind of maximum market consideration, like Nuno-san said, every quarter you're going to be disclosed, you need to be evaluated by the performance every quarter. So to what extent it is important, and is that reason that you go to more than private asset rather than the public asset?
No, because we mark to market our private assets every year as well. They're marked to market. You know, the first thing that the mark to market does, so if we're buying great assets and the markets are down as they were in 08, 09 by 50% or more, it hits my bonus, because my bonus is based on a calculation of mark to market of the assets every year. But does that cause me to not do something that I think we should do? No, it really doesn't. And I think the second thing is it's a matter of education. You need to educate your board, you need to educate your clients that this is going to happen. Markets don't go straight up. But the only time anybody will listen to you is when you're performing really well. So when you're performing really well, you need to go out and tell everybody, listen, this is great, but you know that there's another crack coming in the markets and that there's going to be a huge decline. And you tell them that when this happens, you're going to get really nervous, but you're going to see us at the fund walking around with big smiles on our face, because what it means is assets that we'd like to buy have suddenly dropped in price significantly. And in fact, assets that we would have liked to buy that could have never gotten are suddenly coming available. We like to say that bad is good. And what that means is when the markets turn really bad, it's good for us because we have lots of cash, we have lots of capital flowing in, and we get to access assets at prices we could have only dreamed of. But a lot of that has to do with the education, because what you don't want is your trustees or your board or your clients trying to put the brakes on what you're doing at that time. So when times are really good, that's when you have to start talking about things are going to get ugly again. And when they do, here's the strategy, this is what we're going to do. And they will remember that. And when it gets really ugly, you'll be free to go ahead and to do that. And really the only thing that gets hit is the compensation of the team, but that's very, very short run for a year or two. And our compensation schemes tend to roll over longer periods of time, so it's not a complete wipeout.
Yeah. No, it's a good. By the way, it's interesting. It used to be that in alternatives, particularly private equity, there was a built-in disconnect between valuations and the market, because the underlying assets were not fairly valued. But that has changed significantly, especially over the last 5 years. Among larger firms, spend a significant amount of time. In fact, the numbers are audited, and those are real numbers. They are just like marks, as Gordon suggested. The only thing you could say about it is they're typically a 3-month lag, but that's about it.
My experience is often the private assets are marked, and then if we're selling them shortly after, we'll often find that they have been marked somewhat below market value. And I don't think I've very rarely seen one of our appraisals at the end of the year be higher than the sale price of the asset if it's sold shortly after.
Yeah.
Can I ask something?
Yes.
Well, the mark-to-market issue, I think that's a double-edged sword. Of course, we don't want to catch a falling knife. So, in the time the market keeps declining, it's just a mark-to-market to make our job more difficult if we want to be contrarian. But on the other hand, it will prevent the equity fund manager or pension manager to kind of disguise or hide what's really going on. So I think we require that kind of transparency as a fiduciary duty to our pensioners. And with respect to private equity, I actually the hoping the private equity to give us absolute high return, because I have some skepticism about the correlation argument, because one hand the public equity is being marked to market on daily, and the private equity, it's being evaluated and marked to market much better than before, but it's only done quarterly basis. So you meant to have a low correlation just by that. So I really want the private equity to give us an absolute high return, because correlation in theory, I believe less in it.
That's great.
But I like your fund. Because
No. Then all of this is worth it. Actually, that says 000. So I think we are done. I want to thank the panelists. You guys were awesome. We got away from headlines and to brass tacks, how we really go about our business, which is different than what you read and hear about. And thanks, everyone, for staying with us.
Thank you.
Jonathan.
Thank you.
Thank you very much.
Well done. Thanks.